Hello everyone, Alex here. If you're a first-time homebuyer in Canada, you are in luck. The feds and the province are here to help a bit. In this video, I'm breaking down the 3 federal accounts you can get and 3 rebates that you can take advantage of as a first-time homebuyer in Canada. First off, let's see if you qualify for one of these programs. For that, we need a definition of the first-time homebuyer in Canada, and that is: a first-time homebuyer is someone who is a Canadian citizen or permanent resident and hasn't owned or jointly owned a home before, and hasn't lived in the house with their spouse or common law partner in the previous 4 years. So basically, you just gotta be your first house. Now, let's jump into the 3 federal accounts. There are the big 3. They are the FHSA, the TFSA, and the RRSP. I'm gonna go through them all in order. So number 1, the very first program, the most important one to you as a first-time home buyer, is the First Home Savings Account, the FHSA. This is a newer account, just launched in late 2023, and it has the best features of both the TFSA and the RRSP built into it. So first of all, your contributions to your FHSA are tax deductible. For example, you make $60,000 this year and you can contribute up to $8,000 a year to this account. So if you do that, in the government's eyes, you actually only make $52,000 for your personal income tax. That's the super perk number 1. The ultra perk number 2 of the FHSA is that you can earn interest and appreciation in that account, and those proceeds are not taxed at all. Back to our example, if you contribute $8,000 and you buy some stocks or an ETF or something, and it goes up to $10,000, that $2,000 of extra income is tax-free, man. Open up an FHSA account like tomorrow, go to a bank, fill that bad boy up as fast as you can, buy a couple ETFs and contribute every year. As a first-time home buyer, of these 6 things on the list is the most important one. Now, there's a few rules with the FHSA. First, the maximum contribution total is $40,000 and the max yearly is $8,000. Now, there's no minimum amount of time that your money needs to be stored in the account before you can withdraw, meaning you can deposit and yank the money out like same day. Now, third, you can convert your FHSA into an RRSP at any time you want, and if you let the FHSA kick around for 15 years without buying, it will automatically turn into an RRSP. Whip-de-doo. Go to a bank and open an FHSA. Runner-up, in my opinion, for the accounts is the TFSA, the tax-free savings account in Canada. You can retire with millions utilizing this account, and you can send generational wealth down the family tree. Your kids, your grandkids, your great-grandkids. It is one of 2 of the major investment vehicles in Canada that are actually tax-free. There's your primary residence, which is a tax-free asset. When you sell it, there's no tax. And then there's your TFSA. There are other tiny little accounts and rebates and all this stuff, but generally speaking, those are the 2 big ones. You need to basically kind of have a primary residence and a TFSA. If you're not utilizing those, you're doing something wrong. Now, whatever gains you make in your TFSA are tax-free. You can withdraw whenever you want. You can deposit whenever you want. Total deposit right now, as I'm making this video, is $102,000. Another cool part of it is you get to save your total when you withdraw. So if your account's worth like $250 and you withdraw it all, it stays at $250. You can re-contribute at that $250. That gets saved. Now, the difference between the FHSA and the TFSA is the FHSA you can only use to pay for your house, whereas the TFSA, you can use it for whatever you want. The third program, the third account, the RRSP, the Registered Retirement Savings Plan. Specifically within the RRSP, there is the Homebuyers plan, a little dated, and the FHSA takes precedent, but it's still there if you want to use it. So first up, the basics on the RRSP. As you earn money, the government has a special calculator, and every year your RRSP contribution limit will increase. As you see fit, you can send some of your savings into your RRSP account, and those savings will defer your taxes for that year. What the hell does that even mean? So for example, you make $70,000 in income, and you decide to send $10,000 towards your RRSP. And now you only have $60,000 worth of income according to the government. So the government's only taxed you on that 60 versus the 70. This is all fine and dandy. Invest that 10,000 bucks into a fund or a portfolio of stocks and let it compound for say 30 years until retirement. And then at 70, you can start withdrawing that cash. But at that point, you are finally taxed. So you are taxed on that withdrawal. So the RRSP is simply a tax deferral. So you save on tax now and pay it later. When you have so much money, it doesn't really matter in theory. But the reality is that first-time homebuyers don't have piles of savings year over year, especially after filling up their FHSA. Plus, there's the strategy of holding out on your RRSP contributions until you're in the top tax bracket. That's a whole other video, whole other talk in itself. If you've maxed out your FHSA and you've been contributing to your RRSP, you can still utilize the Homebuyers plan. As a first-time homebuyer, you may take money from your RRSP account to pay for your house. As of now, you can withdraw up to $60,000 tax-free. But the catch is that you have to repay the $60,000, almost like a loan to yourself, within 15 years. Those are the rules. So it's kind of gone the way of the dodo, this one. I don't see it that often. First-time home buyers are typically quite thin financially when they close, and why be stuck on a monthly payment to myself after closing? Just like the FHSA, there's no limit on investment income you earn within the account of the RRSP. However, in this case, funds need to be kept in the account for minimum 90 days. So there's no same day exploit like in the FHSA. Now to put these three together in real life, prioritize your FHSA. It's the obvious decision. Then TFSA, RRSP, this is going to be a case-by-case thing depending on you as a buyer or as a couple. And that's where you can want to talk to, your ChatGPT or a financial advisor or a banker or someone like that. Also, very key here is that you need to create an account. That FHSA account needs to be created in order to contribute that $8,000. It doesn't just back up year over year over year. You have to just open the account. Now that's it for the big three accounts. Next up are the 3 ways of clawing back some of your taxes. There are 2 rebates and 1 tax credit that I'm going to talk about. The first rebate is the GST HST New Housing Rebate. Now this is a new house rebate. You have to buy the home new off a builder. For a new home purchase, let's just do an example. For a new home purchase of $600,000, you actually have to pay HST on it. Yes, that's right. A whopping 13% on $600,000, which is $78,000. Now, for the most part, builders advertise the after rebate prices, but this does vary. But let's go back to the example. So in this example, 13% of $600,000 is 78 grand. 30 grand is the federal part, so that's 5% of the 13. For the remaining 8% in the Ontario portion of the HST is $48,000. This $48,000 we get to help using the new housing rebate. The new housing rebate is up to 75% of this 48 grand with a rule of a maximum of 24,000 bucks. So in this situation, you will be utilizing the maximum amount and you will save $24,000 of that 48. This is a closing based item, so your real estate lawyer handles this for you and they have all the documents ready for you. And that's new build only, but do ensure that your agent and your lawyer is of course aware that you're taking advantage of a new build rebate. Next up on the list is the Land Transfer Tax Rebate you get to take advantage of as a first home buyer. When you buy a resale home in Canada, you pay a special one-time tax on the purchase. This is not a sales tax. This is a specific tax called the Land Transfer Tax. The Land Transfer Tax is very easy to calculate. There's a link to it in the description, a calculator. Let's just use an example of $600,000 purchase. Using the calculator, you will pay $8,475 in land transfer tax at closing. But as a first-timer, you get to subtract $4,000 using the Ontario Land Transfer Tax Rebate. That's the maximum amount. Yay! As a first-timer, you actually only pay $4,475 in property tax. Now, a special, extremely punitive rule in Toronto to double your land transfer tax. Toronto in the year 2008 got their greedy hands on another tax. Sucks to suck. They have their own municipal land transfer tax. So every number I've referred to, you effectively double. But let's just continue the example. So $600,000 purchase in Toronto as a first timer, you're just going to pay a total of $8,475 at closing. Important to note here is your real estate lawyer takes care of this. They do the paperwork, they make sure it's all tickety-boo before closing. To me, one of the most important parts of the land transfer tax is actually just not forgetting about it. Whether you get the rebate or not, or you're a first timer or not, it's easy to forget about. And typically the land transfer tax, you cannot just toss it into the mortgage. That is like cash on hand that you're going to need in addition to your down payment, in addition to your legal fees at closing. And in one of my future videos, I'll be ruthlessly detailing the costs of buying a home, so stay tuned for that one. All right, the first time home buyers tax credit. This is a little different, HBTC. So you can claim up to $10,000 for the purchase of a qualifying home. A qualifying home could be a single family home, a semi-detached house, a townhouse, a mobile home, a condominium unit, an apartment, a duplex, fourplex, basically anything residential for the most part. This is a non-refundable federal tax credit that can save you up to about $1,500 on your personal income taxes. It's designed to help offset some of the costs of closing, legal costs, etc. The way it works is you enter $10,000 on line 31270 on your personal tax return, and you will shave $10,000 off your personal income from the eyes of the government. So there's a rebate of up to $4,000 that your closing lawyer takes care of. And there's a year-end personal income credit that you do on your own or your accountant does. Each of these programs and accounts has its own eligibility requirements and conditions. So it's important to do your homework or speak with a financial advisor, accountant, lawyer to make sure the program actually fits for you. I hope this video has given you a clearer picture on how government programs can help make buying your first home in Canada a little more achievable. If you've had any questions or need any personalized advice, hit me up on Instagram, Facebook, or YouTube. Descriptions are in the channels. The details are in the descriptions on the channel. My contact details are in the channel's description, and let me know what else I could make a video about in the comments. And don't forget to subscribe for more tips on navigating the home buying process. Thanks for watching, and I'll see you guys in the next one.